So I want to go a little bit deeper on some rotation that I'm seeing in the market today on Wednesdays where I seem to just turn on the camera and talk about whatever. But I think this is important because I think a lot of people who got started in the markets during 2020 or even more recently are used to that the only thing that goes up is tech. And the problem with that will be is if we are getting into a period where we're rotating out of tech and into other sectors, that gets really hard for people to trade and for people to really understand. It gets really hard to say, okay, now I need to learn to trade X, Y, and Z. But it's important because the sectors that got us into the last problem generally don't get us out of the next. So I'll show you guys what I mean here. And really, when it comes down to it, I think we look at COVID for this particular example. So if we go to back on the SPY, let's do a weekly chart. Right? We all remember COVID, this massive pop down and then rip back up that happened here. What got us out of this mess was people buying things that they thought would be, COVID darlings, we could say. So things like Peloton that just ripped during the same period of time. Zoom, we all remember Zoom. I think this was worth more than ExxonMobil at some point. But then what happened to these? They came all the way back down, uh, almost to zero, right? Peloton almost went bankrupt a couple times. Same with Zoom. So when the party's over, then it's time to move on to something else. Now, we don't know if the party's over, specifically talking about semiconductors and large cap tech, just yet. It could just be this is a pause in an overall uptrend, and we are going to break out to new highs on all of these. But the way I'm looking at it is that the AI trade has had a couple years in it. And now what is happening is we're seeing some strength under the hood. I'm going to focus on two sectors that I think are interesting to me, but I'm also going to show you how I found them and the way that I think it makes sense to find these. So you see this moving average, and you notice I probably don't have moving averages too much on my chart right now. This is the 200-day moving average, right? It's FOMC day, so this is one of those days in which I'm not doing a lot of trading, so I do a lot more analysis and looking at different charts. And you can see the SPY is below the 200-day moving average, and it's flattening out a little bit. This is actually the EMA, and that might trigger some people. So let's just go and grab the SMA. So moving average simple right here. So we'll grab on the simple and then we'll change these up. So what we're looking for is you got to pick a point when it comes to looking at the something to anchor things to, right? In this case, we're just going to use a 200-day moving average, and we use it because so many people talk about it, and that's really only the main reason to use it, right? So we're well below the 200-day moving average here on the SPY, and it's starting to flatten out to the downside, and that's not what really you want to see. But as you go through your different sectors, and a lot of people ask me, well, what should I be looking at? Well, the SPY sectors are a good place to start. And the SPY sectors, I mean, right, financials, technology, consumer discretionary, consumer staples. There's, I think, 11 that you can go through and just look at daily. So, for example, we look at XLI. XLI is industrials. It's above its 200-day moving average and looking pretty strong. If you just compare these two charts, right, keep this one in your brain while we work here, and then go to XLI, this one's pushing up. So, industrials. What do we mean by industrials? John Deere, Caterpillar, things that build things. That seems to be doing very well. And then if we look at XLF, the banks, although they pulled back with the overall market, still well above this 200-day moving average and actually looking pretty strong. So it's just showing us that there are sectors of the market that are doing great, even if XLK, which is technology, is way down below its 200-day moving average. This is the rotation that we want to see. So what causes this rotation? Is people taking profits. Someone had a really good trade in, a lot of people had a really good trade in all of these tech names. The valuations, not that I know anything about valuations as a CMT, but the valuations of these things were getting really, really high. So they sold out of these names, and then they got to do something with the money. Most hedge funds, institutions, large funds, they have to be invested for some period of time, and they have to be invested generally 90% plus of their portfolios. So what we're always looking for is we're looking for what potentially can we get into next, and what potentially can we rotate into. So when the system's over at StatsEdgeTrading, we're looking at things like JP Morgan and the SYK, a couple of these bank stocks, that made perfect sense to me because if we're buying things that are pulling back, it makes sense that we buy the strongest things. So a couple of these bank stocks make sense. So as you're going through, and this is kind of a call to those people who are newer traders, just understand that it doesn't have to be Apple, Nvidia, Meta, Google, whatever. In fact, it likely won't be those for a period of time. So we need to understand what is potentially going to be that next thing and start pushing in that direction so that you're familiarizing yourself with these new stocks because again, it changes all the time. It will likely continue to change, and whatever gets us out and into new all-time highs in the market likely won't be the thing that sold off. So expand your horizons, look around at different stocks, find areas and systems to do this. That's a basic system that I've just kind of showed you guys and said, what is the furthest up from the 200-day moving average? If the SPY is below the moving average, whatever's above it should be relatively strong.